ahead if these futures numbers hold. Let's bring in Kian Soon, CEO and Fund Manager at Astral Asset Management. So Kian Soon, when we looked at the past year, phase 1, phase 2, phase 3, now we're cycling into cyclicals. How do you determine value when you look at these companies?
I think when we look at these companies, a lot of the valuation has been affected because of the pandemic situation this year. But in terms of determining value, it's very important for us to identify companies with very low debts on their balance sheet. And at the same time, we also look at the amount of growth and recovery they would have in the coming year, because in terms of earnings per share, a lot of these companies is going to show a strong rebound. And if they have very amount of debt to this, as well as a strong cash flow situation, this company's valuation is considered low. I think there's a very high chance that all these companies will perform very well in the coming year.
Does it include Chinese assets and the outlook for the economy? Because we've seen in the past week how there's no real way of determining which way the wind is going to blow. Just yesterday, we saw the Chinese stock markets coming under pressure because FTSE Russell put some of the Chinese firms on, or kicked them off the benchmark indices. So in that sense, how much of that is a risk to the Chinese markets?
I think it all depends on what is the time horizons you are looking at for the companies. For a lot of Chinese companies, if you are looking at them from a mid to long-term investment horizon, you are less likely to be affected by all these short-term news, whether they are included in certain indices or not. Because ultimately, if you look at them from a 3 to 5 years perspective, and the companies have shown potential for growth, as well as a strong balance sheet, as well as operating in a very favorable macro environments, this is not going to be an issue after all.
What about issues of tensions between the US and China? How does that figure into the equation?
I think these issues have existed since 2017, 3 years ago, when the trade tensions started. And it's unlikely to just go away. But over time, if you look at a lot of the Chinese companies that are affected by the trade tensions, they have evolved and they have moved their factories or their warehouses overseas. And if you look at the domestic Chinese companies, a lot of these companies are not affected by any form of trade tensions. Companies providing educations for the Chinese consumers, Chinese companies providing F&B domestically. There are large number of companies that are simply, not affected by this equation after all.
Okay, we also saw that these Chinese SOEs, from the defaults, there seems to be a bit of a structural paradigm shift in the expectation that the government's going to continue supporting them, and that sparked some of the sell-off in the markets as well. Does that then change your assessment of Chinese banks?
I think defaults on all Chinese companies do happen. Actually, defaults on Chinese SOEs do happen. Recently, the eyebrows are raised simply because the amount of defaults are too big, basically creating the notion that no companies are too big to fail. The interesting thing is the Chinese banks typically are strong supporters of their own SOEs, and they tend to have huge loans that is exposed to their SOEs as well. Having said so, I think it's time and it's healthy for the Chinese market to actually acknowledge the fact that just because you are SOE backed by the government, it's not like you're going to have all your AAA ratings as well as all your loans are going to be secured. I think what happened is going to encourage all the banks, Chinese banks and international banks, giving loans to Chinese SOEs to be more selective, to do their portfolio management as well, and in terms of looking at the loan assessments to be more rigorous. And I think this is very good overall for the entire market.
Do you expect Singapore lenders to do something similar, looking at their exposure to Chinese SOEs?
Let's be very clear here, right? I mean, if you look at the 3 banks, local banks that have exposure in China, they have only 5 to 15% of their loan books that's exposed there. And if you look at the amount of default, I think this is acceptable because in this pandemic crisis, in this situation, the amount of default that is happening in Singapore corporates is actually far exceeded that those that have happened in China. And as long as all the Singapore banks, which I believe they have always been very rigorous in their loan assessments, I don't think this is going to be a major issue for our local banks.
Okay, we've been talking so much about Asian assets now. Give us very quickly, what do you think is going to be the major driver of US markets in 2021?
So we saw a very strong rally in November this year, which sort of make us all forget that there's a global economic contraction for the year, right? And if we look at what is going to happen globally as well as the US markets, I think it's going to be driven by 4 key factors. First is the central bank's liquidity of more than 10 trillion that has been pumping globally. Second is we are anticipating more fiscal stimulus that will be coming in most of the developed countries. Obviously, not to forget the positive vaccine development news that we kept hearing these days. And last but not least, is the anticipation of a strong economic rebound and growth in 2021, given the low base we have these years. And the US markets, I think, will continue its rally. And the rest of the world will actually sort of catch up as we see sector rotations, geographical rotations, so on and so forth. And honestly, if you are investors, right, I think you'll find little reward to invest in negative interest rate bonds, nor would you find any reward in a yieldless cash environment. So where else could you invest? So that's why I say the global equity markets is an attractive place to be in.
Kian Soon, thank you for your time with us today. Kian Soon, Astral Asset Management. Breaking economic